dear professional students. You are welcome to Portfolio Management. This is one of the courses in level 2. Now, what we want to do now is to look at behavioral finance. When we are talking of behavioral finance, what we simply mean by that is that this is a concept that is based on the alternative option or alternative notion that investors, or at least a significant minority of them, are subject to behavioral bias that may not be in their financial decision or can be less than fully rational. So the evidence of this bias typically come from cognitive psychology literature and has then been applied in the financial context. So we have been talking of rationality, that before someone can behave, it has to follow the market. Although not everything that is rational that is correct, but rationality means that you go with the majority and you do according to what they do. That is what rationality means. And behavioral finance is when some significant minority of these investors, they are subject to behavioral biases that in their own financial decision can be less than fully rational. So evidence of this, as you said, is typically come from cognitive psychology literature and has been then applied in financial context. Now, there are different examples of biases, as we said, that cognitive this behavioral finance is about behavioral biases. What are the field of these biases? We have overconfidence and over-optimism, which indicates that investors overestimate the ability and accuracy of the information they have. That is overconfidence and over-optimism. We have another one, which is representativeness, which says that investors assess situations based on the superficial characteristics rather than underlying probabilities. That is representativeness. We also have another one which says conservatism as another bias from behavioral finance. And these forecasters cling to, or this is where forecasters cling to prior belief in the face of new information. When information surfaces, the forecaster will still cling to former or prior beliefs. We also have availability bias, which indicates that investors overstate the probability of recently observed or experienced events because the memory is fresh. That is when they overestimate that probability, and that's what we call availability bias. We also have another one which says frame dependence and anchoring. Frame dependence and anchoring. This simply says that the form of representation of information can affect the decision making. That is what we know as frame dependency and anchoring. We have another one which we call mental accounting, which indicates that individuals allocate wealth to separate mental compartments and ignore fungibility and correlation effect. And also we have regret aversion, which simply indicates that individuals make decisions in a way that allows them to avoid feelings emotional pain in the event of an adverse outcome. So that is some of the examples. There are others we have under it. Now, when we are talking of behavioral finance, once again, it's something that challenges the use of a confessional utility. Confessional what? Utility, which we refer to as rational behavior, is something that challenges of a confessional utility function based on the idea of risk aversion. So outcomes are evaluated against a subjective reference point, that is purchase price of a stock, and investor are loss fast, which exhibits the risk-seeking behavior in the face of losses and risk-averse behavior in the face of gain. You can see the behavior. Someone is risk-seeking in the face of losses, is losing and is still taking the risk, and one is gaining and it's also affording to take the risk. That's part of the behavioral finance we said. Now, part of this is we have the limit to arbitrage. So the limit to arbitrage as part of the behavioral finances is that a key argument in behavioral finances is the existence of behavioral biases among investors. We call them noise trader. So this behavioral will affect the asset prices and returns on the sustained bias if limit to arbitrage also exists that prevent rational investor from exploiting short-term mispricing, and by doing so, returning the price to equilibrium value. So evidence suggests that limit to arbitrage exists. So this situation implies arbitrage opportunity leading to swift correction of the pricing anomaly, but the author find a degree of persistence that indicates barrier to arbitrage. We discussed something on these limits to arbitrage earlier. I think it might not be. Anyway, there's something like this under derivatives. We talk about limits to arbitrage, where the activities of noise trader, the investor, will prevent the professional or fund manager from taking advantage of mispricing, thereby leaving the mispricing unnecessary longer in existence. That's a limit to arbitrage. Now, we have another one which is overconfidence. We said something on overconfidence earlier, and according to this note, he said it is a propensity of individuals to overestimate their own knowledge and ability to perform. We have mental accounting, which define the tendency to segregate complex information into manageable mental account. So in investment time, people separate their assets into different categories depending on the purpose each category fulfill. Other types are, we have hidden bias. When I'm talking of hidden bias, is the propensity of investors to mimic the crowd without taking into consideration their own judgment. When you follow the crowd without judging anything, what they do is what you want to do. Even though they are entering fire, you want to enter it without thinking or taking cognizance of, is it going with your own financial objective or not. That is a hidden bias. We have another bias, which is status quo bias. When I'm talking of status quo bias, people affected by this bias prefer maintaining their current position. They want to maintain their current position irrespective of the changes in their environment. That you see some managers that owns company, they just want to retain that name, CEO. So even though they are making losses in that business, they stick to it because they didn't want to leave that title. Another one is what? Efficient market hypothesis. When I'm talking of efficient market hypothesis, according to Farmer in SMT, Farmer describes an efficient financial market hypothesis as one in which security prices completely reflect the available information. Further, the investor in this scenario are well informed and make rational choices, such as the pricing of security cannot occur. It's one of the biases as well. Also, we have prospect theory as another bias under behavioral finance. So this is a concept which is given by Kahneman and Tafasi in 1979. This theory analyzes the decision-making process of individual under risk. Decision process of what? Of individual under risk. Here, the choice is determined in terms of loss and gains. It suggests that same level of joy and pain does not have equal effect on people. It suggests what? Same level of joy and pain does not have equal effect on people. So an average individual tends to be more sensitive toward losses than gain. So this tendency is called what? Loss aversion. Loss aversion is when an average individual tends to be more sensitive towards loss than gain. So people want to avert loss. So when you are too sensitive to losses, when you are making losses, you are so curious, but when it is gain, you don't actually bother. That's on that. We have another one, which is a availability bias. We have said little on that earlier. We said is the tendency of individual to give more weight age to recent information which could be recalled easily. That's availability bias according to this note. We have a disposition effect. When we are talking about disposition effect, is a tendency of investors to start selling the shares that have gained value early while holding the losers for too long. That is disposition effect. You can see the kind of irrational behavior. Why you don't hold the one that is making loss and sell the one that is why you don't hold the one that is making gain and sell the one that is making loss. But this one is when you sell the one that is making gain value earlier and hold the one that is losing for too long. Now, the next one is anchoring and adjustment as another bias. So, a heuristic use of, this is a heuristic used to estimate an unknown value by starting with a known figure. That is anchor. Let me come again. I say anchoring and adjustment is an heuristic used to estimate an unknown value by starting with a known figure. An anchor, which is then adjusted to arrive at a final value. You started with you estimate or known value through a known, which we then adjust to the final value. So in this case, people tend to get biased toward the anchor rather than away from it. The next one is what? Market anomalies. So we talked about market inefficiency here. So it simplifies or it indicates that aberration in financial market which cannot be explained by efficient market hypothesis. That's market inefficiency, or I thought it's called market anomalies. For example, speculative bubbles, crashes, overreactions, and underreactions. These are the market anomalies. The next one is narrow frame bias or narrow framing bias. This is a myopic approach of investor wherein they make investment decision without considering the context of their entire portfolio. It's like following hiding bias we said earlier. So people affected with this bias focus on their attention to specific, seemingly attractive investment option while they tend to overlook the full range of options available to them. That is when you narrow framing bias. The next one is optimism bias. Optimism bias cause people to believe that they are less likely to experience negative incidents. So in financial terms, it is tendency of investor to overestimate its expected return on a security. This one is common among the religious people. They will tell that they know that God will not do bad things to them. They will not bother to analyze anything. They just believe in that what they will see will be positive. That's than that. The next one is representativeness. Although we have said little on this, but let's see what this one says. Representativeness, according to the explanation here, says a heuristic driven bias, where an individual assesses their option by comparing its similarity with an existing prototype. That is representativeness. Is it representing what you want? Is what you want to do will take after or will look like the one you have suggested, that is existing prototype. Want to compare the action you want to take with. Next one is, anyway, this is the end of the behavioral finance and some of the biases under it. And don't forget to say behavioral finance is when people do something that is outside something we can call rational. Understand? So it's about cognitive, the way perspective, the way and the manner with which you consider certain thing. That's what people these days are brought into into financial management. So with this, we have come to the end of this. Till we meet again, stay safe.